Wonderful. So, super good to have you. I want to give a very brief introduction. Then I know Homam has a lot to share, and it's definitely a perspective that is maybe not paid enough attention to. So, most founders and CEO obsess about product market fit, and rightfully so. It's super important. Now, what many, I can say, of us don't think of so often is your own company as being the product itself. It's a product for investors that investors buy into, and often it's not just one metric. There's a whole story around it. So, Homam, you're the founder and CEO of Studytube. You created a business that's been around for more than 10 years. You've raised a whopping 50 million euros over time, and you've scaled from 5 to like 25 million euros over the past 5 years. And as I was told, very consistently, which matters in this context. Mm-hmm. And we would love to, like, the title of this story, of this talk is really, how do you go beyond just revenue and metrics, and how do you find the stories and the trend lines that investors buy into? Welcome on stage again, Homam.
Thank you very much.
And I think we're going to dive right into it. So, do you want to unpack for us a little bit? What do you mean when you say like the trend lines and the stories behind, or in addition to the revenue numbers?
Yeah, sure. First, before we start, any CEOs, founders, please hands up. Anyone raising capital here or involved with capital raising? Of course, some of the folks that I know. Earlier we had Björn from Verdane on stage. They're also an investor in Studytube, and he shared sort of this placard, right, where he said, listen, there are 15, 20 metrics, and if you do really well on those metrics, then Verdane would love to invest. So, but that's a snapshot, and I think there's one layer deeper. When you go one layer deeper into sort of what the Björn type of people are saying, which are sort of semi-robots you need to feed with data, because that's kind of the investor prototype, then especially what did the previous years look like? Like if were you growing 30% year on year just this year, and last year 50, and the years before that 15? So the trend line, I would argue, matters just as much as the actual snapshot number, because investors want to sort of get credible story into the future, and your data should kind of support that.
So to make it predictable, to make them trust and be confident that it continues like that.
Yeah, and you have to understand that's what you're selling. You're selling a trend line, ideally.
Yeah. And was there any kind of specific event or moment when you realized this?
Yeah, I think if you start working with venture capital and you get these guys in your board, you learn a lot, right? So I was raised by venture capital and private equity in the sense that they've been in my board for the last 5-10 years. And I had one board member. She was great, super smart. And she at one point said, also for a little bit of context, we're not an AI super company that's growing 100% year on year, right? So if you're one of those, none of this matters, because you're growing 100% year on year and keep doing whatever you're doing. But then there's a group where we belong, where you're growing 35% year on year, and you're doing that very consistently. And that, I would say, that's the majority of SaaS sort of sits there. And the cool thing about SaaS is it compounds over time, right? So we're at 25 million AR, and we're going to get to 100 million AR because it's just a function of time at the point where we are. And sort of this board member of mine said, listen, Homam, if you go below 30% growth, then you're not a scale-up, but you're an SME. That's one thing she said. And the other thing she said was, given that we as a company historically have always been around this 35% sort of growth mark, at least for the last post 10 million AR, she said, we gotta be super intentional about all the other metrics that we sort of have in the company. And you have to be just as obsessed about sort of the design of those metrics as you are design of your sort of product. And that kind of stuck with me for two reasons. So one, I learned like, oh fuck, if I go below 30%, I'm an SME. And you're going to be valued on EBITDA, which is probably the worst thing you can be valued on if you're an ARR company, right? But this is like, this is what you're afraid of. You work 15 years, you get to 50 million euros in ARR, and someone says, I'm going to pay you 20 times profit. That kind of sucks if you can get 8 to 10 times ARR. So that's super important, but that's well known, that growth is super important when you're in the venture game. The other thing, sort of what I found interesting was I got to think about sort of the design of my metrics, the way I think about the design of my product. Because like you said at the beginning, I think we have two customers. One is you bring a product to market for your regular customer base that pay you. And the other segment is if you are venture-backed, you're probably going to have more rounds. And then the other customer that's equally important are the fine folks of Verdane and others like Carlyle and BlackRock, whatever, whomever you at some point want to get on stage. And for them, you have to have product market fit as well. And that, I think, for me was an important realization on how we run the business.
It's a super good perspective. You told me beforehand when we spoke that kind of there are more metrics than ARR, and some of these metrics are all valued a bit differently. Like what does it mean for you literally in practice as you manage your company and set the strategy? Yeah, sure.
So one of the things I think we realize is not every year of ARR is worth the same. So, just like everyone else at the beginning of the year or at the end of the year, you make a plan for the next year, right? And then you look at sort of, hey, where's my growth going to come from this year? And then you say, okay, I have my existing customers. So there's, I want to achieve certain net retention rate in the existing customer bucket. Then you say, I want the direct business we're doing in this geography, I want to get this much from. And then the direct business we're doing in the DACH region, I want to get this much ARR from. And then there might be other, like a channel, for example. You say, from our channel, we want to have this much. Okay, you create a plan. That plan will get you hopefully to, in our case, 35% growth. But then, if we then look at sort of this year, we want to do some fundraising again. If I then think about, okay, when I'm going to market, and I want to convince you as a potential investor that I'm going to go from 25 million to 100 million, then I want the trend lines in all these growth buckets to support sort of my growth story. So in our case, for example, we had terrible net retention 5 years ago. We were at 100% net retention rate. And we know like, ooh, that's not great. We got to get, ideally to 110% net retention rate. So we started obsessing about, hey, how can we increase this year over year? And 5 years, stuff starts compounding. We're now at 108%. And before we go to market this year, for example, we're going to kill ourselves to get to 109%, for example. Why? Not because 109% in itself is so fantastic, but it's because it's slightly better than the year before. And if you were here at Björn's talk, what these investors do, pattern recognition, right? That's all like, they don't know what you're doing in the business. Like, they look at the numbers and they're like, all right, so 5 years ago, it was 100%, then it was 102%, then it was 104%, then it was 106%, then it's 108%, and now Homam is saying it's going to be 110, 112, 114. Yes, I buy that trend line, right? That's a consistent story also when they go to an investment committee. It will be, kind of makes sense. If the story would have been 104, 102, this year 110, and then I say next year 112, it's like, I'm not sure about that. Like it's, right, because of even though maybe the absolute number this year is going to be higher. And once you know this, right, once you know sort of this is sort of how the market looks at your company, the way you're designing features, the way you're doing all the other stuff in your company, then this is very valuable insight.
I guess it also makes your ARR just so much more robust because let's say you break it down into 10 buckets, 10 KPIs, sub-KPIs, one of them fails, but the other 9 are still there.
Exactly.
And so you just have much more predictability. Now, it almost sounds like you're an architect an architect of not just of your company, but of your ARR. So is that the fair summary of this?
Yeah, you could say that, right? Like you're a value creation architect, right? You have to think about, okay, you have to craft the equity story. You have to think about sort of how are your numbers going to support your story going forward. And I think people underestimate how much impact you can actually have there strategically, and sometimes shifting like your focus towards making one bucket grow a little bit faster, it will build a trend line that will go forward. I'll give you an example also. Let's go back to the net retention rate example. So again, we know the market values net retention rate at the moment disproportionately high. It's really important, and ideally you go above 110%. And then we have some history obviously in the company, and then we know, okay, net retention rate, what is that? So you have churn, you have contraction, you have, in our case, upsell, which is, company buys more licenses, and then we have cross-sell, because we have a multi-module product. Churn is, you can improve that over time a little bit, right? So if you have 6% churn, maybe you can make a 5 out of that, right? So that you can make some impact there, but it's hard. You'll do product investments, you do all that stuff, you take care of that. Okay, so we know that, right? So you model that in. Second thing you do is you look at contraction. That's like a company becomes smaller. It's a little bit out of my hands in our case, so that's hard. But I know historically it's like 3%. Then upsell is like, company buys another company, more licenses, you expand a little bit. We can have some impact on that, but it's not massive either. And historically what roughly your base has been doing, let's say 7-8%. And then you have cross-sell. Now, in cross-sell, for example, we knew we have 5 products. Everyone always starts with 3 products, and then you have 2 products you can cross-sell them. Either they start at the beginning or they come after. Then we know, like, these 2 products have what they call an attach rate. So once you buy this, I know,
70% chance I'm going to buy
this. 70% chance you're also going to buy this. And then the other product maybe has 60%. And you can improve that over time. But what we saw is we were modeling this towards like 2030. And then I see like, okay, in 2028, I want to have 113% net retention rate. But I see 108. Well, that's a problem, or 109, right? And I think as a value creation sort of, architect, then you got to figure out, okay, what does that mean? Okay, we need to buy a company to cross-sell, whatever product, or we need to launch like another product. And understanding that, because if you don't do that, you're in a fundraising process, for example, you don't have an answer to that, it, maybe destroys, 20% of the value of your company.
Super interesting. To make it super tangible, maybe some of you here in the audience have kind of moments or upcoming meetings already in your head. Is there some, like a common mistake or a big mistake you've seen, either you made yourself or you've seen other founders do when it comes to selling their trend line?
No, I mean, maybe answer to a different question, I don't know. But what sort of comes up to me is what we used to do is we didn't like look at our growth or our business in like 6, 7, 8 different buckets. Like it's so much easier to prove something bottom up and say, anecdote. I was doing an investor call like 2 weeks ago, and I'm like presenting a plan. I'm saying, okay, we're going to go from 25 million to 120 million in AR, and I'm doing it bottom up, right? I'm saying, hey, here's this bucket. This is what this bucket has been doing the last 5 years. First it did 1 million, then it won 2.2, then it did 1.6, then 1.8. Do you believe this bucket will do 2.2 and then continue? Well, so yeah, I can see that. All right, great, check. All right, I'll take it. Next bucket, you do the same. Next bucket, next bucket, next bucket. All of a sudden we go to a bucket where the trend line isn't that great, right? And then also, this one. This one is not working. I'll give you credit for the rest. I'm like, yeah, I'll take it because I have credit for 100 million in AR. So you're basically saying you agree with this 100 million in AR and you're challenging this 20 million. All right, let's park the 100, talk about this. And I think if you can instill that, understand your business in these mini buckets, we didn't do it at the beginning, and that really helped us.
And the beauty is all of these drivers and KPIs, they're multiplicatorily connected, right? If they all grow a few percentages combined, it
exactly,
becomes
it compounds.
To the square to the
yeah.
Wonderful. So I know we're a little bit behind schedule, but I want to make sure we get at least one question. If it's really short, it can even be 2 questions. So does anybody have a burning question?
Very technical story.
Oh, come on. Yeah, okay. These 2, keep it short if possible.
How do you approach this a sort of trend line prediction? Do you really break down the KPIs and plan ahead for the coming, let's say, 10 years?
Well, 5 at least, and then you try to do 1 or 2. But let's say, how we do this, for example, you take the bucket, we're selling into small, medium enterprises. We're selling into enterprises, we're selling into this segment, this segment, this segment. So I take one of those buckets. Let's say SME, right? And I know SME in, for example, the Netherlands. We did, 2 years ago, we were doing 800,000 euros in ARR. The year after, we did 1 million in ARR. And then, so I tell the team, like, listen, guys, it's really important we do 1.2 million. So even if we can do in the aggregate more in, let's say, by also doing enterprise, for me, the 120 is non-negotiable because I don't want this trend line to break. Because I know that if I do 120, everyone will believe the 140, 160. But if 120 again becomes, 100 again becomes 100, someone will draw the flat line. So just having that understanding, doing it bucket for bucket, it will make you a lot of money in the fundraising process. And then you need to deliver.
And one last one. We're 30 seconds of the session.
Yeah, about the buckets. How do you define the buckets?
It depends. For us, it's sort of what the go-to-market team is centered around, right? So where do sort of the responsibilities lie? So net retention rate, that sits primarily in the sort of delivery team, where you make implementation, customer success, and account management sort of responsible for. And then, you can have a channel that's being managed by, for example, VP channel or something, and then, that person owns everything from the channel. And you talk with that person and say, hey, this is what we need. And you do that for SME, you do that for enterprise, and for geographies, you can do that. Most logically, however your go-to-market is oriented. And then it also becomes a management problem to fill those buckets.
I love it. My brain is going like this. Like, what drivers and then...
But you're in this business, right? I mean, this is for you. This is exactly how you guys look at companies, no?
Absolutely. I mean, we drilled down into customer segments first and foremost. Of course, NRR. We are lending to SaaS businesses, and the quality of the revenue is for us the most important thing we lend against.
Yeah.
Thank you for that segue.
Thank you,
Homam, for coming over. Super insightful. I hope we took something away. I'm sure we all did. Give him a hand. Thank you.
Thank you.